Introduction to Momentum Indicators. Now that you've seen a bit about support and resistance indicators, it's time to introduce another type of technical analysis tool to your arsenal: momentum indicators. What is so useful about momentum indicators? They're useful for resolving the following kinds of common trader dilemmas that support and resistance indicators can't answer. For example, a currency pair is broken past all prior support and resistance points and is making new historic highs or lows, so there aren't any support and resistance levels to tell you if it's a good time to enter or exit a position. You missed entering positions early in a trend that has been going on for a while. How can you tell if there is still time to ride the trend? How can you reduce or eliminate the risk that you're not buying at the top or selling at the bottom? You could wait for a pullback, but by waiting, you risk missing even more of the move. You're in a winning trade and you want to ride it for all it's worth, but you don't want to risk staying in too long and losing some of your gains. Or you're approaching resistance and your planned exit point. Do you take profits or leave some or all of the position in hopes of letting profits run with a trailing stop? Look what happened to gold from May 2009 to August 2011. From May 2009 to August 2011, it kept hitting new all-time highs and had only 8 down months out of 27, rarely pulling back to anything more than very near-term support levels. Those waiting for significant pullbacks never got in and missed the biggest trend of the year as gold steadily hit new all-time highs. We traders and investors get paid for being right about what happens in the future. However, the support and resistance indicators we've covered thus far tell us about what happened in the past. While that's helpful for predicting future price behavior, support and resistance indicators can only tell us about the strength of support and resistance levels. They're missing the other half of the picture. They can't tell us about whether a trend is strong enough to break past a certain support and resistance level. Moreover, they can't tell us anything about future price movements when a currency pair or other asset has broken past all prior support and resistance to new historic highs or lows. What's a trader to do? Use momentum indicators. They can give us a better idea of future price movements because they show whether a trend is strengthening or weakening. They can tell you if an asset is overbought or oversold relative to the price range over a given period. This helps us decide whether the trend is more likely to continue or to reverse direction. Knowing these can help you forecast changes and be more profitable. In short, momentum indicators can give you additional clues to put the odds of being correct even more in your favor. There are many momentum indicators, but for now, we'll just introduce a few of the most effective and easiest ones to use. Double Bollinger Bands, moving average crossovers, 3 kinds of basic oscillators, moving average convergence, divergence, MACD, relative strength index, RSI, and stochastics. So how do momentum indicators work? As their name suggests, momentum indicators focus on rate of price change. While the exact mathematical calculations and emphasis vary among momentum indicators, they all attempt to provide a certain perspective on whether price is changing at a faster or slower pace, whether that changing rate indicates trend strength or weakness. Here's an example. A steady increase in the speed at which price is rising or falling suggests trend strength. However, too rapid an acceleration is often interpreted as a sign of trend exhaustion, or a blow-off top, or bottom for downtrends. That suggests a final dramatic surge in optimism, or pessimism for downtrends, that drains out the remaining buyers or sellers for downtrends, and sets up the end of a trend and coming trend reversal. When that happens, you'll hear analysts say that the pair is either overbought if the price has risen too fast or for too long, and thus is expected to reverse and move lower, oversold if price has fallen too fast or for too long, and so is expected to move higher. Indeed, if you compare a timeline of the EU crisis and a weekly gold chart that covers those 3 years, you'll note that gold often spikes to new highs. We'll cover this and other intermarket relationships and how to use them later.